Welcome to the I Nurture videos.
Dear students, in this video we will learn about future contract and types of future contracts traded in India. Let's first understand what do we mean by a future contract. It is an agreement between a buyer and a seller to deliver a specified quantity and grade of a particular asset at a predetermined price on a specific date or during a specific month through a designated exchange. The asset can be financial instruments like equity or physical commodities. Journey of futures contracts started way back in 1865 when Chicago Board of Trade (CBOT) introduced standardized grain agreement. The market grew very fast as producers and buyers of the commodities increasingly felt the need to protect themselves from price fluctuations to sustain them in a volatile market. This need to hedge the risk established the markets for futures contracts. Futures contracts are traded on an exchange and the exchange facilitates the trading. Exchanges also give guarantee to both the counterparties that the contract will be honored and thus eliminates the counterparty risk. Futures contracts are standardized with respect to the delivery month, the quantity, quality, delivery location, and the payment terms. Date of maturity is specified by the exchange on which the futures contracts are listed. The exchange will also specify the amount for one contract. It also tells the counterparties how to quote the futures price, the product quantity and quality, the place of delivery, etc. As all the other elements of a futures contract are standardized, it enables the market participants to concentrate on only one element, that is, the price. There are different types of futures contract available for trading in a stock exchange. They are fundamentally classified on the basis of underlying asset. Let's look at some of them. Financial futures contracts to buy and sell a specific financial instrument like currencies, treasury bills, etc. for a pre-specified price at a pre-specified future date. They are the most popular futures in the market. Individual stock futures are the simplest of all available derivative instruments. The underlying asset is the individual stock. The main difference being the holder of the future contract will not be considered as a shareholder of that particular company and will not be eligible for any dividend that may be declared. Stock index futures are based on stock market indices. For example, the S&P CNX Nifty is popularly called the Nifty futures. The stock index futures are traded as an asset in the market and they cannot be settled by physical delivery. Such futures are always cash settled. In commodity futures contract, underlying asset is a commodity. Here, buyer and seller agree on a predetermined price, quantity of the commodity to be delivered at predetermined future date. The underlying asset, in this case a commodity, can be anything from wheat, rice, corn to metal and oil. Interest rate futures are an agreement to buy or sell a debt instrument at a specified future date at a price that is fixed today. The underlying asset could be treasury bills or government bonds. Currency future is a futures contract to exchange one currency for another at a specified date in the future at a pre-agreed exchange rate that is fixed on the date of entering into the contract. For example, on NSE, the price of a future contract is quoted in terms of INR per unit of the other currency, example, US dollars. Students, in this video, we learned about futures contracts, different underlying assets, and support extended by exchanges while trading these futures contracts. Trust you will find the video useful.